Hello and welcome once again to CN Professional Institute. In this video, we are going to look at IFRS 15, International Financial Reporting Standard 15, which talks about revenue from contracts with customers. Revenue from contract with customers, right? Before we start with this standard, let's look at a brief history of the standard, right? So this standard, IFRS 15, is a merger or was a merger, an amalgamation of two standards, IAS 11 and IAS 18. So IAS 11, which talks about construction contracts, and IAS 18, previously called revenue, right? These two standards were merged to form IFRS 15, revenue from contract with customers, right? So in September 2015, the board issued effective date for this standard, and then the effective date was 1st January 2018. 1st January 2018. So this standard became effective, right, from 1st January 2018. Right. So we say it's an amalgamation of two standards, IAS 11 construction contract and IAS 18 revenue. So IAS 11 construction contract focused more on the long-term contract, right? Like you go into a contract with a customer to build a house, okay, or a building, an estate, a school. I mean, long-term contract. Those that take at least some time to complete, right? So in that case, revenue was measured according to the progress, right? So when the entity recognizes revenue based on the project, based on the progress, okay? So if they think that the contract is 50% complete, then they record 50% revenue and then 50% cost of sales. So IAS 11 was more of like long-term contract, okay, where revenue is recognized based on what? The progress, okay? And then it was mainly performance obligation over a period of time. IAS 18, revenue was more of the one-time stuff where performance obligation is satisfied today and revenue is recognized of today. So you sell goods today, risk and rewards are transferred to the customer, in which case you recognize revenue today, right? Or as at that very date. So 18 was more of like the, if you should put it, the one-time transfers and then the one-time stuff, right? It doesn't really involve long term or another period of time where transfers or goods are sold today, revenue is what recognized, right? So that's something small about IFRS 15. Okay, it consists of two standards, IAS 11, IAS 18, and then the effective date was 1st January 2018. So let's start. Let's start with the objective of IFRS 15, right? So the objective of IFRS 15 is to establish principles an entity must apply to report relevant information to users of the financial information about the nature, amount, timing, and uncertainty of what revenue and cash flows arising from contract with customers, right? So this is the key objective. This is the objective of IFRS 15. It is establish principles the entity must apply, okay, to report relevant information to users about the nature. So it reports relevant information, right, about the nature, the amount, timing, and uncertainty of revenue and cash flows from contract with customers. So we see sometimes the amount of revenue to recognize in your books will differ. Okay, it's affected by so many factors, like the transaction price, it's affected by so many factors, like the variable consideration, future value or time value of money, consideration payable to customers. So there are so many factors that can affect the revenue. Okay, so it says it establishes the principle the entity must apply to record the amount, because this amount of revenue is affected, can be affected by so many things, the timing, when should the revenue be what? Recognized? When? And then the uncertainty of the revenue. Sometimes there are instances where revenue is based on, or recognition of revenue is based on certain conditions. And so when the entity is able to meet those certain conditions, then it can recognize what? Revenue, right? And then even the cash flows as well. So that's the objective of what? IFRS 15, to establish principles the entity must apply, okay, to report relevant information about the nature, about the timing, uncertainty, and amount of what? Revenue. So these are the key things that we look at. We look at the nature of the revenue, timing, when is it received, uncertainty of the revenue, and then the amount, how much do we record in our books. Let's look at the scope of IFRS 15, right? So the scope of IFRS 16, what does it cover and what does it not cover, right? So it says this standard covers all contracts with customers, okay, to provide goods and what? Services in the ordinary course of the business, except the following contracts. Except the following what? Contract. So it says IFRS 15 covers all revenue with contracts, and all revenue contract with customers to record revenue, right? So all contract with customers to record revenue or to recognize revenue, except these ones. Now, why are we exempting these ones? It is because these ones, they have their specific treatment, they have their specific standards, right? Under which they fall under. So we apply the rules of these standards to account for revenues arising from this. So let's start with the first one. So it says contract with customers under leases. That's IFRS 16. It is previously called IAS 17. So lease contract under the scope of IFRS 16 is not accounted for, or the rules of IFRS 15 doesn't apply to revenues or amount received from parties, okay, under IFRS 16. Now, you see, if you look at leases, sometimes the lessee and the lessor will go into arrangement, and then the lessee, okay, pays an annual income or rental to the lessor. Are you getting it? You see, such annual income or annual rental payment should not be accounted for under IFRS 15. We have to go and apply IFRS 16. So we should use IFRS 15 revenue, but we should use IFRS 16, right? Insurance contracts under the scope of IFRS 16, they are also exempted. Okay, we apply the rules of IFRS 17. We will look at all the standards. Then we have financial instruments and other contractual rights or obligations within the scope of IFRS 9, financial instruments, IFRS 10, consider financial statement, IFRS 11, joint arrangements, IAS 27, separate financial instruments, and separate financial statements, and then IAS 28, investment in associates and joint ventures. So these things are not covered. You see, if you pick financial instrument like this, okay, one party and the other. So one party buys financial instruments. So when you buy financial instruments in another, let's say you buy debt instrument, right? To you, the buyer, it becomes a financial asset. Okay. Now, if you remember financial instrument, or if you have an idea about it, when you are amortizing it, you see, we have the effective interest rate, which is normally the income that we record in our books, right? It says such contract, okay, such income, such uh, amount that we record as income, okay, it doesn't fall under IFRS 15. So we have to apply the rules of financial instrument to account for such transaction, to account for such income, or to account for such interest was received. So contract with customers that can give rise to revenue, that can make us record some small income, which are under these things, should not be included or should not be accounted for under IFRS 15. And it says non-monetary exchanges between entities in the same line of business to facilitate sales to customers or potential customers. So just put these things down. These are the scope. This is the scope. IFRS 15 applies to all except leases under IFRS 16, insurance contracts, IFRS 17, financial instruments, and then we go to our consolidated financial statement. And then if you are doing consolidation, okay, we pick consolidated financial statement, which we apply the acquisition accounting, the one buying the financial, the one buying the shares in the other entity will pay some amount, right, called the purchase consideration. Now, to the other entity, how would the other entity account for it? Those things are not under IFRS 15, right? So that's it. So these are the exceptions, okay? The exceptions. Now, let's look at, so that's the scope, okay? That is the scope of IFRS 15, revenue from contract with customers. Let's look at definitions and core principles. Definitions and what? Core principles. So this is revenue. What's revenue? So revenue has been defined in the conceptual framework, right? It has been defined in the conceptual framework, right? So it says revenue is income arising in the ordinary course of the entity's ordinary activities. You can refer to the conceptual framework for the definition. And then a customer is a party that has contracted with an entity to obtain goods or services that are an input to the entity's ordinary activities. Customers basically are those that patronize the product of an entity, right? Then a contract here is an arrangement between two or more parties that creates enforceable rights and obligations, right? So when we talk of a contract, we just mean a binding agreement between two parties, right? Where one party can enforce, or both parties can enforce the right. So if one defaults, the other can take an action, right? So it's just an agreement that creates a legally enforceable right where the parties can enforce their right. And we said contract can either be oral, okay, it can be oral, it can be written or what? Implied. Now, you can enter into a contract with the customer to supply goods, to buy and sell, where you can just sit down, have the contract printed and signed, right? Or you can just say with your mouth, supply me with 50 bags of cement and I'll pay you this amount. It's oral. So it can either be written and signed, can be oral or implied. Implied means it's not written, it's not like oral, but maybe from an action, from your action or from what you've done before, it can imply that there's what? A contract. Right, so contract is not necessarily it shouldn't always be written or oral. It can be implied. Maybe our actions, okay, can lead to a conclusion of what? A contract, right? And then we have the core principles here. So these are the key definitions. If you look at the topic is revenue from contract with customers. Revenue from contract with customers, right? So we define revenue, we define contract, and then we define what? Customers. Core principle. The core principle, IFRS 15 is based on a core principle that requires an entity to recognize what? Revenue in the manner that depicts the transfer of goods or services to the customer, and at an amount that reflects the consideration the entity expects to be entitled to in exchange for those goods and services. So the core principle of IFRS 15 If you remember inventory, the core principle, the subsequent measurement was to recognize or measure inventory at the level of cost and NRV. IFRS is also saying that the core principle is to recognize revenue in a manner that depicts the transfer of goods and what services. So, revenue cannot be recognized unless the goods and services are transferred. The risk and rewards associated with the goods are what? Transferred to the customer. That's where revenue can be what? Recognized. This is, we should recognize revenue in a way that shows that the goods have been what? Transferred. I getting it. The services have been performed. In that case, we cannot recognize revenue. So that's one core principle. In a manner that shows that indeed the goods and services have been what? Transferred. The risk and rewards have been passed on to the customer. And at an amount, the amount, very important, that reflects, at an amount that reflects, okay, the consideration that the entity expects to be entitled what? To. At an amount that reflects the consideration the entity is expected to be entitled to. So we said there are so many factors that can affect the amount of revenue to recognize. That is what we call the transaction price. There are so many factors that can cause that, or that can affect the transaction price. Okay, we said one can be the time value of money, variable considerations payable to what customers. All this is, we look at them subsequently. As we are moving on, we look at them in details. We said these factors can affect the amount of what consideration or the amount of revenue to recognize. And as I saying, we should record revenue that shows the exact amount that the entity expects was received. It shouldn't be over, it shouldn't be below. We have to factor in all the conditions that will affect the revenue, that will affect the amount, and we record that exact what amount, right? So these are the core principles. We have to record revenue in a way that shows that indeed the goods have been transferred and at an amount, exact amount that we expect to what receive from the exchange of goods and services. The amount should not be more, it should not be less. We have to factor in the factors that will affect the amount, right? Very good. So these are the core principles. Let's look at the 5-step model. The 5-step model. So IFRS 15 is all about this. This all what the standard is about. IFRS 15 is about the 5-step model. So that's all what the standard is about. So we'll look at each of them, the 5 steps. We'll look at 1, 2, 3, 4, 5. And by the time you are done going through this 5-step model, you will perfectly understand IFRS 15, revenue from contract with customers, right? Now, if you look at the core principles that we looked at, the first one says we should record revenue, okay, in a manner that shows that the goods have been what transferred, and at an amount that shows or that reflect the consideration the entity expects what receive, right? So it says if we should adhere to the 5, if we should apply the core principles, the 2 core principles that we've looked at, then these are the steps that we are going to follow in order to recognize what revenue. So it says applying the core principles involve following a 5-step model as follows. So the first step is to identify the contract with the customer, identify the separate performance obligations, determine the transaction price, allocate the transaction price to the performance obligations, and 5, recognize revenue when or as an entity satisfies performance obligation, right? So we are going to pick each of these steps. We are going to pick each of them and we'll look at it because that's what the standard is about, right? So let's start with the first step. Identify the contract with the customer. Identify the contract or contract with what? The customer. So that's one of the first, or that's the first step in the 5-step model. Identify the contract or contract with what? The customer. So let's look at step 1. Identify contract with the customer. Now, before an entity can record revenue, we said the entity has to follow the 5-step model. the first step or the first one is to identify the contract with the customer. So is there a contract with the customer? We know that for a contract to exist, we said the contract can either be written, oral, or what? Implied, right? It can be written, it can be oral, or what? Implied. So before we can say there's a contract with the customer, we have to follow some procedures and check, okay, do we have a contract with this customer? Right? And we said if there's no contract with the customer, then we cannot record revenue or we cannot recognize what? Revenue, right? So it says, so if you look at this one, right? It says step one, identify the contract or contract with the customer. It says a contract does not exist if each party has an enforceable right to terminate a wholly unperformed contract without compensating what the other. We said for a contract to exist, there must be enforceable what right. Are you following? So it says if one party can terminate the contract without compensating the other, then there's no contract. So we have a contract, you supply me with 20 bags of rice, I pay you this. If I can say, okay, I'm not going to supply you with the bags again. I'm not going to deliver the bags of rice to you again. If I can just do that, I can terminate the contract without me compensating you, without me paying an amount of compensation to you, the customer. Then since there's no contract, right? So for a contract to exist, the parties or one party should be able to take an action, right? To enforce the other or to force the other to what? Abide by the rules. And even if the other party fails not to or fails to stick to the principles, fails to stick to the contract, the one party has to be compensated. So the one who defaults has to compensate the other, right? If one party or if the defaulting party has no right to compensate the other party, then there's no contract, right? So IFRS 15 says for us to say there's a contract with the customer, we have to meet 5 conditions. If these 5 conditions are met, then we can say there's a contract with the customer. If one is absent, we cannot say there's a contract with the customer. So be very careful. All these 5 conditions must be met. The 5 sub conditions should be what? Should be met before we can say there's a contract with what? The customer, right? What's the first one? It says, one, the parties have approved the contract and are committed to perform their respective obligations. So approval of the contract. Both parties have to approve what? The contract and are committed to perform their obligations. So the contract is buy 5 bags of or bring me 50 bags of cement and I'll give you let's say 10,000 cedis, right? Bring me 50 bags of cement and I'll give you 10,000 cedis, right? Now, has the other party agreed? Both of them must agree, or they have to agree, right? They have to approve the contract. Okay, I'll do this. I'll deliver you the 50 bags of cement, and then you pay me my 10,000 cedis. So they have to approve the contract, and they have to show some kind of commitment, right? Not just approval. There should be a bit of commitment, okay, to perform such obligations, right? So under identify contract with customers, we said the first one is the parties have approved the contract and are committed to perform their respective what obligations. That's one. Then two, the entity can identify each party's right. The entity can identify each party's what right. So with the same example I used, so you just deliver or bring me 50 bags of cement and I'll give you 10,000 cedis. What are the rights here? What are each party's right? So one party's right is to receive the cement. The other party's right is to receive what the 10,000 cedis. So one will deliver the cement and one will receive what? The 10,000. So these are the right. I have the right. One party has the right to receive what? the 50 bags of cement, and the other party also has the right to receive the money, the 10,000 cedis. Are you getting it? So we have to identify each party's what right. And in the payment terms, the entity can identify the payment terms for the goods and services to be what? Transferred. So what are the payment terms? Okay, bring me my 50 bags of cement. With the 10,000 cedis, I'm not going to pay you all the 10,000 cedis. I'll pay you 5,000 right now when you bring it. Then in 2 weeks' time, I'll pay you another 2,000, making 7,000. And in 3 weeks' time, I'll pay you 3,000, making 10,000. So what are the terms of the payment? Are you paying everything now, or you divide it? The 10,000, you divide it. You pay part now, you pay part in the future. You pay a non-refundable amount and later top it up. So what are the terms of the payment? Are you getting it? So you see, the entity can also identify, or should be able to identify the payment terms. Are you paying everything now, or will part be paid in what? The future. So that's the payment what terms. Payment terms should be what? Identified. Okay. Then, point 4, the contract has a commercial substance. That is, it is expected to change the risk, timing, amount of an entity's future what? Cash flow. With the example I've given, you see, one person receiving 10,000 cedis, okay, and the other person paying 10,000 cedis will change the amount of the entity's cash flow. It will surely change it. Are you getting it? So one is paying, one is receiving. So one, it will affect the entity's future cash flow, the amount, right? And this is also expected to change the risk and the timing, the risk and then the timing or the amount. So it should also have to have like probably the timing. So when would that amount be received? The timing. Okay. When would that amount be received? And then the risk associated with what? Such transaction. And then finally, it is probable that the entity will collect the consideration. Also very important. If you think, if you divide the 50 cement bags the 50 bags of cement, the customer cannot pay you, then there's a question mark. Then it's not probable that the consideration will be collected, the entity will collect the consideration. Because let's say you know the one who is buying, the customer, right? It's not in it's not in a good position. There are some economic circumstances surrounding the customer that will make it very difficult for the customer to pay. Are you getting it? Maybe the customer is bankrupt. The customer is in an environment where there's high competition. So the customer you don't think the customer can raise that amount. So is it probable that you, the one selling, you can receive your money, you can get your consideration back, right? So you have to look at all this. Is it possible that the one you are selling to can pay your money? What conditions is he or she facing, right? So we have to look at all these things, and then we can see there's a contract with what? A customer. So it says any consideration received in respect of a contract that does not meet the criteria is recognized as a liability, right? It says any amount recognized in respect of a contract that does not meet the criteria is recognized as a liability. So let's say, with the same example, the 50 bags and the 10,000 cedis. Let's say the customer, you've paid the customer 50,000 cedis, and you are waiting for the cement to be delivered to you, right? You are waiting for the cement to be delivered to you. So you are waiting patiently for the cement to be delivered to you. Now, it says the one that has received the money, okay, the one that has received the money, who is supposed to deliver the cement, any amount that the person has received, and then after applying these conditions here, after applying this recognition criteria, the person thinks that he or she cannot meet, he or she cannot meet or one of these conditions are not met, then it's saying that we should record liability. So let me give you an example. So I receive, let's say now I'm the customer or I'm the one to deliver the cement. I receive the 10,000 cedis, so I have to deliver the cement, right, to the one buying. I have received the 10,000, I have to deliver the cement. It says if I can't deliver the cement or if these conditions are not met, the contract has not been approved, it's not probable that the consideration will be received. If these conditions are not met, then I, the one, me, that have received the 10,000, I'm supposed to deliver the bags, the 50 bags. I don't have to record the 10,000 as revenue. I have to record it as liability because I'll be paying back because these conditions are not met. So I have received 10,000 to deliver cement or supply cement. I know I cannot supply the cement probably because of the last point that I'm facing some challenges. So I don't think I can pay the consideration to my counterpart, right? So since if that's the case, then me, the one, the one who has received the 10,000 cedis. I have to record liability, not revenue, because the conditions are not met. Right. So since any amount received that has not met this criteria should be recorded as what? A liability. Now let's look at one example here. Right. Let's try this question. Let's try this question. So it says CN is a real estate developer. CN enters into a contract with Mr. A for the sale of a building for 1 million. Mr. A intends to open a restaurant in the building. The building is located in an area where new restaurants face high level of competition, and Mr. A has little experience in the restaurant industry. Mr. A pays a non-refundable deposit of 50,000 and and enters into a long-term financing agreement for the remaining 5%, which he will pay out of the proceeds of the restaurant. CN Limited can repossess the building if Mr. A defaults, but cannot seek further compensation. And it says one, have the parties approved the contract and are committed to perform their respective obligations? So let's use this example to see if there's a contract with the customer. Don't forget, we are still on the first step. Identify the contract with the customer. So we are checking if there's a contract with the customer and we know the conditions, right? The conditions to be met for us to say there's a contract with the customer. We said one, the parties should have approved the contract and they are committed to perform what? Their respective what? Obligations. Then each party's rights should be what? Identified, the payment terms identified. The contract must have a commercial substance and it is probable that the consideration will what? Received. We said if these conditions are met, then we can say there's a contract with what? A customer. That's the first step is met. So we are looking at it. We are scanning through to see if this scenario here can qualify as a contract, or we can say there's a contract with what? The customer. So let's see the first part. So let's apply the the sub steps under step one. So one, have the parties approved the contract and are committed to pay their respective and are committed to perform their respective obligations. This is yes. Why are we saying yes? Now, it says CL enters into a contract with Mr. A for sale of what? A building for 1 million. If the contract has not been approved, would there be a contract? Are you getting it? So this have the parties approved the contract? They have approved the contract. That's why we are saying there's a contract. Okay, CN enters into a contract with A, so that there's a contract. Okay, then can CN Limited identify each party's right? This also yes. Why? What are the rights? The right is that CN Limited will sell, enters into a contract with Mr. A for sale of building worth what? 1 million. So CN Limited will sell the building to who? To Mr. A. So CN would deliver the building and receive 1 million. So what are the rights? The right is that CN Limited will receive 1 million Ghana cedis and Mr. A will receive the building. That's all. These are their rights. CN Limited will receive the 1 million after delivering the house, and then Mr. A will also receive the building. So these are the rights. Can CN Limited identify the payment terms for the goods and services performed? Yes, the payment terms are also clearly stated in the question. The first one is that Mr. A will pay a non-refundable deposit of what? 50,000. So 50,000 will be paid first, and then later there will be a top-up through a financing agreement. So these are the terms of the payment. All the 1 million will not be paid once, right? It will not be paid once. It will be paid step by step. Are you following? It will be paid step by what? Step. So everything will not be paid once. 50 million and 50,000 first, and then the remaining, there will be a financing arrangement, right? Does the contract have a commercial substance? Also, yes. Why does it have a commercial substance? One, it can have impact on the entity's amount of cash flows. It can impact the cash flows. And then two, it can affect the timing. So look at the timing, right? Look at the timing of the cash flow of the cash flow. Look at the timing. So it can impact the timing. 50 cedis, 50,000 is paid as non-refundable deposit. And then the remaining will be paid future, or the remaining will be paid from what? A financing arrangement. So it can impact the timing, okay, the amount and the risk of the entity's future cash flow. So there's a contract. So the contract has a commercial what? Substance. It can impact the monies, the cash flow of the entity. And then the last one is saying that is it probable that the entity will collect the consideration? Is it probable that CN Limited will collect the consideration? And this one is no. So this one is no. It's not probable. So let me write, yes, I'll write a no here. We have two questions. Is what? No. Why is it not probable that CN Limited will collect the consideration? Look at it. We were told that, if you check the question, it says Mr. A, okay, intends to repay the loan from income that he would derive from a business, right? What's the business? The hotel industry. So he's in the hotel industry and he intends to repay the loan from income derived from a business, right? And this business faces what? A significant risk. There's a high competition. I getting it. Mr. A has limited experience, right? Look at this. Mr. A has little experience in the restaurant what? Industry. He has little experience in the restaurant what? Industry, right? So if Mr. A has little experience in the restaurant industry, it means Mr. A might suffer or will face a high level of competition, will struggle to even make money, because if you're in an industry where there's high competition, it won't be easy for you to just make it, to just come out like that, right? You face a high level of what? Competition. So even any revenue, getting income at your initial stage will be very, very difficult for you, right? And it says Mr. A also lacks other income or asset that could be used to repay the loan, right? And then Mr. A's liability under the loan is limited because the loan is a non-recourse, right? Now, the main reason why we can say that it is not probable that the consideration will be collected is that we said Mr. A has little experience in the restaurant industry. Mr. A is in an area where there's a high level of what competition, and he has little experience, he's just starting. So how are you going to make the money and pay? Right. So we said it's not probable that the consideration will be what received by CN Limited. Right. And then the last one is, does the transaction meet the IFRS 15? Does the transaction meet the IFRS 15 applicability criteria? And it is no. Can you see 1, 2, 3, 1, 2, 3, 4? 4 conditions are yes, are met, but the fifth one is no. So we say this does not meet the IFRS 15 applicability criteria, and therefore we say there's no contract with the customer. So we cannot apply, or we cannot use IFRS 15 to account for this. Are you getting it? One condition has failed, one test has been failed. The last one, it's not probable that the consideration will be received or will be collected. So in that case, we say that the IFRS 15 applicability criteria cannot be applied to the contract. So the contract does not meet the IFRS 15 applicability criteria, right? So we say this is not, so this doesn't fall under IFRS 15. There's no contract with the customer. So step 1 is out. So we can apply IFRS 15 here. If you remember, it says any amount. If you come here, it says any amount received in respect of such amount should be recorded as what? A liability. Can you see the 50,000 here? The 50,000 non-refundable deposit. So we are going to receive, or we are going to record this 50,000 as a liability. Are you getting it? You have to record it as what? A liability. That's what the standard is saying, right? So the amount that has been received, amount to 50,000, should be recorded as a liability. And this amount will continue to be recognized as a liability until the application criteria are satisfied, or until either of the following occurs. Okay, at which time the amount should be recorded as what? Revenue. So the entity's performance obligation is complete and the contract has been terminated. So where the contract is terminated, right, then we can go and record the 50,000 as revenue. Are you getting it? It will continue to be in our books as a liability till the contract has been what? Terminated. And then the consideration received is non-refundable, which we have here. It's non-refundable. So we have to wait till the contract is terminated before we can record this amount as revenue. And then we also have to wait till the entity's performance obligation is complete and substantially all of the consideration in the arrangement has been collected and stuff. That's where we can record revenue. So then the 50,000 will be in our books as liability. So that's it. So there's no contract with the customer. So we are done with step 1. Step 1 says identify the contract with a customer. Identify contract with the customer. We said for a contract to exist with a customer, this criteria should be met, the 5. If one is absent, there's no contract with the customer, and any amount received should be recorded as what? A liability, right? So with this example to illustrate that. So we are going to continue in part 2. In part 2, we are going to look at the remaining steps. We look at step 2. Step 2, identify the separate performance obligations and its conditions, right? And we'll also look at some examples on it. So I'll see in part 2 of I'll see in part 2 of IFRS 15, revenue from contract with customers.